Imagine opening your bank account on the first of every month and seeing money deposited. Not because you worked for it that day, not because you sold anything, not because you did anything at all, just because you own the right assets. That's not a fantasy, it's a structure. And the people who've built it did it by understanding one simple principle. Not all dividend stocks pay at the same time. Most dividends are paid quarterly, 4 times per year. But if you build a portfolio intentionally across companies with staggered payment calendars, you can engineer monthly income from annual investments. Today, we're covering 7 stocks specifically chosen for their combination of payment timing, yield, and dividend sustainability. Because a high yield that gets cut is worth nothing. Since it's growing yield compounding for 20 years is worth everything. Before we get into the picks, a quick primer on what separates investment-grade dividend stocks from yield traps. Quality dividend stocks have 4 characteristics. First, a payout ratio that leaves room for coverage. The payout ratio is the percentage of earnings or funds from operations paid out as dividends. For regular companies, anything above 80% is a warning sign that the dividend is stretching the balance sheet. For REITs, payout ratios are naturally higher because they're legally required to distribute 90% of taxable income, so you look at different metrics. And second, a strong balance sheet, manageable debt relative to assets, investment-grade credit ratings when possible. Third, a sector with durable demand. Essential services, infrastructure, consumer staples, businesses that people use regardless of economic conditions. Fourth, management with a track record of not just paying but growing the dividend. A dividend that grows is exponentially more valuable over decades than one that stays flat. With those filters in mind, here are 7 stocks. Stock 1, Realty Income Corporation, ticker O. Realty Income is the gold standard of monthly dividend payers and has been for decades. It's a REIT, a real estate investment trust, meaning it owns commercial properties and is legally required to distribute at least 90% of taxable income to shareholders. And Realty Income has paid its dividend monthly without interruption for over 640 consecutive months. It has raised its dividend more than 120 times since going public in 1994. The company calls itself the Monthly Dividend Company. And it has earned that name through consistent execution, not just marketing. Portfolio. Over 15,000 properties in the United States and Europe leased on long-term net leases. Leases mean the tenant pays property taxes, insurance and maintenance on top of rent. Realty Income collects a clean, predictable check. Tenants include 7-Eleven, Dollar General, Walgreens, FedEx, and Walmart. Businesses that disappear in recessions. They're the stores and distribution centers that operate in any economic environment. Current yield approximately 5 to 6%. On a $50,000 investment, that's approximately $2,750 to $3,000 in annual income, paid monthly in equal installments. And Realty Income recently entered Europe through acquisitions in the UK and Spain, diversifying its revenue internationally for the first time. A meaningful expansion of the growth runway. To understand, REITs are interest rate sensitive. When rates rise, REIT valuations often fall as investors compare yields to bonds. Realty Income fell significantly in 2022 during the rate hiking cycle. It has navigated multiple rate cycles across its history, but entry price matters. Buying near rate cycle peaks at compressed valuations has historically produced better forward returns. Stock 2, Stag Industrial, ticker STAG. STAG is another monthly paying REIT, focused on single-tenant industrial real estate, warehouses, light manufacturing facilities, and distribution centers across 41 states. The industrial real estate sector is one of the strongest performers in commercial real estate, driven by the relentless expansion of e-commerce, requiring logistics infrastructure in every major metropolitan area. Commerce still represents approximately 15 to 17% of total U.S. retail sales. As that percentage grows, the warehouse demand grows proportionally. Bank owns the physical infrastructure where goods move from manufacturer to consumer, and that infrastructure is in increasing demand. STAG currently yields approximately 4 to 5% paid monthly. The portfolio is diversified across hundreds of properties and hundreds of tenants, meaning no single vacancy is catastrophic to the income stream. Stock 3, Main Street Capital, ticker MAN. Main Street Capital is a business development company, a structure that provides debt and equity financing to small and mid-sized American businesses. BDCs are like REITs, required to distribute 90% of income to shareholders, creating naturally high yields. Main Street is consistently ranked among the best managed BDCs in the country, and it has paid a monthly dividend for years with regular supplemental dividends on top of the base payment when earnings exceed the regular distribution. 8% on the base dividend, with supplemental dividends pushing the effective yield higher in strong years. This is a high yield, but Main Street covers it with a diversified portfolio of loans and equity positions across 200-plus companies spanning multiple industries. The management team has maintained a strong track record of credit quality through multiple economic cycles. Supplemental dividends they've paid consistently for years signal that they routinely earn more than the base payment requires. Risk. BDCs are leveraged and cyclical. In severe recession with widespread small business defaults, BDC net asset values take real hits. Main Street has a stronger balance sheet and more conservative underwriting than most of its peers. But this is categorically a higher risk position than Realty Income. Position size accordingly. 4. Agree Realty, ticker ADC. Agree Realty is a net lease REIT, similar structure to Realty Income, but with a focused portfolio concentrated in necessity-based retailers. Top tenants read like a list of recession-resistant businesses: Walmart, Home Depot, Tractor Supply Company, Dollar General, Walgreens, TJX Companies, Kroger. These are businesses where people spend money regardless of economic conditions. Groceries, home improvement, farm supplies, healthcare, the categories that don't pause during downturns. Agree switched from quarterly to monthly dividend payments in 2021, demonstrating management confidence in the income stream. 50% of its annualized base rent comes from investment-grade rated tenants, one of the highest quality portfolios in the net lease REIT sector. Current yield, approximately 4.5 to 5%. 5-year dividend growth rate has been approximately 6% annually, meaningfully above inflation. Stock 5. Pembina Pipeline, ticker PBA. Moving outside real estate, Pembina is a Canadian energy infrastructure company that pays monthly dividends and trades on the New York Stock Exchange, making it fully accessible to American investors. Pembina owns and operates pipelines, natural gas liquid storage and fractionation facilities, and export terminals across Western Canada and the United States. A critical feature: Pembina's revenue is predominantly fee-based, not commodity price-based. They charge for moving and processing volumes, a usage fee model similar to a toll road. When oil prices drop, they don't lose their margin the way a producer does. They lose revenue only if volume decreases, and volumes have been resilient across multiple price cycles. Current yield, approximately 5 to 6% paid monthly. Pembina has maintained or grown its dividend through the 2015 oil crash, the 2020 COVID collapse, and the 2022 volatility. Note for American investors: Canadian dividends are subject to a 15% withholding tax in taxable brokerage accounts due to the U.S.-Canada tax treaty. This reduces your effective yield. Since the withholding does not apply inside an IRA or Roth IRA, hold Pembina in a tax-advantaged account to receive the full yield. Stock 6. EPR Properties, ticker EPR. Empor is a specialized REIT investing in experiential real estate, movie theaters, education facilities, ski resorts, golf complexes, eat-and-play entertainment venues, and family entertainment centers. Hence, this is deliberately the highest-risk pick on this list, and it deserves full transparency about why. EPR suspended its dividend during COVID when every experiential venue in its portfolio was simultaneously closed by government mandate. That suspension, which lasted approximately 14 months, was a hard test of how severe sector-specific risk can get. EPR reinstituted and has since grown the dividend. The current yield of approximately 7 to 8% reflects both the income potential and the risk premium the market assigns for that COVID history. For investors willing to take concentrated sector risk with a portion of a portfolio, say 5 to 10% of total holdings, EPR adds meaningful yield and diversification into non-traditional real estate that has no direct competitor in the publicly traded REIT space. The post-COVID rebuild has been conservative. Better lease structures, more diversified tenant exposure, stronger liquidity. But know what you own. This requires more monitoring than a Realty Income position. 7. LTC Properties, ticker LTC. LTC Properties is a healthcare REIT focused on senior housing and skilled nursing facilities. The demographic thesis is unambiguous. 10,000 Americans turn 65 every single day through 2030. The demand for senior housing and care facilities is not optional and not cyclical. It is driven by biology. The 78 million baby boomers moving through their 70s and 80s will require significantly more healthcare real estate infrastructure over the next 2 decades than currently exists. OTC pays monthly and yields approximately 5 to 6. Like many healthcare REITs, it faced challenges during COVID. Senior facilities experienced occupancy drops and elevated operating costs simultaneously. The recovery has been gradual but consistent. This is a long-duration hold tied to one of the most powerful and unalterable demographic trends in American economic history. How these 7 work together as a portfolio. An equal weight allocation across all 7 $10,000 in each at a starting investment of $70,000 would produce a blended annual income of approximately $4,200 to $4,900 per year at current yields. That's $350 to $408 per month in passive income. beginning in month 1, at $150,000 invested, approximately $9,000 to $10,500 annually, $750 to $875 per month. $900,000 invested, approximately $18,000 to $21,000 annually, $500 to $1,750 per month. At $600,000 invested, approximately $36,000 to $42,000 annually, $3,500. Scales linearly with invested capital. The challenge is building the portfolio, and the path there is consistent monthly investment during your accumulation years, with all dividends reinvested until you actually need the income. A few portfolio construction principles. Hold all of these inside tax-advantaged accounts if possible. REIT dividends are taxed as ordinary income, the highest rate. At a Roth IRA, they grow and pay completely tax-free, dramatically improving net returns over time. Never concentrate more than 25% of a dividend portfolio in any single position. If realty income is your favorite, it can anchor the portfolio at 20 to 25%, but the remaining holdings diversify across income sources, sectors, and rate sensitivities. I must reinvest every dividend payment during accumulation. Every monthly payment buys more shares, which generate more dividends next month, which buy more shares. This is the compounding engine that turns a $10,000 starting position into something substantial over a decade. Let's make that concrete with actual numbers on realty income specifically. $10,000 into realty income at a 5% starting yield. Year 1, you receive $550 in dividends. As you reinvest every payment through the DRIP, Dividend Reinvestment Program, buying fractional shares automatically at whatever the price is that month. Now assume realty income grows its dividend at approximately 4% per year, which is close to its historical average. After 10 years with that 4% annual dividend growth and full reinvestment, your yield on the original $10,000 cost, what investors call yield on cost, reaches approximately 1%. The position is worth approximately $18,000 based on price appreciation alone, and it's now paying you $810 per year instead of the $550 you started with. You didn't invest another dollar. The compounding did the work. And that's the mechanism. It's not exciting. It's not fast. But in year 10, your original $10,000 is generating income as if it were an 8% yielding asset, and the position is worth nearly twice what you paid. When you're building this portfolio with limited capital, the order of operations matters. Start with SEHD, the broad dividend ETF, before buying any individual names. SEHD gives you 100+ dividend-paying companies in one purchase for a 0.06% expense ratio. It's your diversification foundation. Once you have at least $5,000 to $10,000 in SEHD, you can start adding individual names like Realty Income or Stag Industrial. Never put less than $2,000 into any individual dividend stock position. Below that threshold, the dividend payment becomes trivial. $2 per month on a $500 REIT position doesn't move any needle, and the transaction costs of reinvestment become inefficient. Build the foundation, then layer in individual names as your capital grows. The tax treatment of dividends from this portfolio also matters, and it varies by security type. Its REIT dividends are classified as ordinary income by the IRS, meaning they're taxed at your regular income tax rate, potentially 22%, 24, 32% depending on your bracket. Modified dividends from regular corporations like SEHD's underlying holdings are taxed at the lower long-term capital gains rate, which is 0%, 15%, or T%. That difference can be enormous over decades. $20,000 per year in dividend income. Ordinary income taxation it costs $4,800 in taxes. Qualified dividend taxation at 15% costs $3,000. $1,800 annual difference invested for 20 years is over $100,000 in foregone wealth. This is why holding REITs specifically, Realty Income, Stag LTC, Agree Realty, inside a Roth IRA is not just a nice-to-have. It's the single biggest optimization move in this entire portfolio. All the REIT dividends become permanently tax-free. All the qualified dividends in a taxable account stay at the lower capital gains rate. And structure the accounts correctly, and you keep significantly more of what this portfolio generates. Which of these 7 is most relevant to where you are in your financial journey? Tell me in the comments. And if there's a monthly dividend stock you think belongs on this list that I didn't include, drop the ticker below. The suggestions in the comments have genuinely influenced future video topics on this channel. Hit like if this gave you a concrete starting point and subscribe. Next week we're going somewhere completely different. The Japanese money philosophy most Americans have never heard of, and why it quietly builds more wealth than almost anything in Western personal finance.